We finished this year FY17 with a revenue of 118,000 crores, with a revenue growth of 8.3% in CC terms, adding $1.4 billion in constant currency dollar revenue. So in terms of reported dollar revenue, we concluded the year with $17.58 billion, which is a growth of 6.2%. From an operating margin perspective, our operating profit crossed 30,000 crores for the first time. We ended with $4.52 billion of operating profit, operating margin of 25.7% for the full year. Coming to net margin, again, we had a fairly strong year, closing the year at 22.3% in terms of net margin profitability and total reported net profit of 26,300 odd crores. From a cash flow perspective, we had a very strong year. Our cash conversion rate crossed 100% for the first year at about 103%. And cash from operations, we generated about 26,900 odd crores, 27,000 odd crores from it, a growth of more than 15% on a year-on-year basis. So that's the summary financials from an annual perspective. Looking at it from a segment perspective, if you look at markets, our North American business grew 7.5%. UK grew slightly more than 6%. But our best performance came from continental Europe, which grew at 13.5%. India also had a good year, growing more than 10%. And other regional markets also did quite well. So overall growth across all markets, with Europe leading with a very strong 13.5% growth. From a vertical perspective, once again, broad-based growth across verticals. Our largest segment, BFSI, grew at 7.5% for the full year, with some of the relatively smaller ones like manufacturing, life sciences, communications, travel and hospitality, energy, all of them recording more than 10% growth, double-digit growth. Similarly, from a service line perspective also, the newer service lines like infrastructure continues to grow very well. But digital as a service has crossed $3 billion. We generated $3 billion in digital in FY17, and it accounted for 16.7% of our revenues for the full year. When we look at it from a people perspective, we added about 33,400 odd people in the year net to close the year with 387,000 people. Our attrition continues to track downwards, and we continue to enjoy the industry's best retention rates. So overall, across financial performance across markets, service lines, performance in new services like digital, and in terms of employee metrics, we had a fairly satisfying year in a challenging operating environment, with challenges coming both from the economic side as well as from the financial markets in a currency perspective. So quite happy with the way we have ended the year, and sets us up with confidence for the year ahead. We'll spend a few minutes in terms looking at it from a quarterly perspective, the Q4 perspective. We ended Q4 with a revenue of 29,642 crores. In constant currency terms, we had a growth of 1%, and we lost about 1.3% due to currency volatility during the quarter, ending the quarter with reported INR revenues of 0.3% down. From an operating margin perspective, similarly, our constant currency operating margin was at 26.1%. Whereas due to currency impact, we have a reported margin of 25.7%. And net margin perspective, for the full year, we did 22.3%, and for Q4 also we have a same 22.3% net margin, with net profit of 6,600 odd crores. The cash conversion for the quarter also remained very strong. We have more than 100% cash conversion this quarter also, with the cash from operations to revenue of more than 25%, and generating close to 7,500 crores of cash in this quarter. So overall, a strong set of financials in a relatively seasonally weak quarter. From a segment perspective, we had growth across all our faster growing segments. So if you were two segments, which is BFSI and retail, had negative growth. If you leave that aside, all other vertical industries had very strong growth, and we recorded 3.4% CC terms growth, excluding these two verticals. BFSI had a growth of 0.4% negative, and retail had a degrowth of 3%. Retail is facing structural challenges in the industry, which we'll talk about further. BFSI is more a cyclic or a more period-to-period change. We continue to see strong traction in BFSI and have expected to bounce back strongly as we go forward into the next quarter. From a geographical market perspective, once again, North America has a reported revenue down of 1.8%, whereas Europe and UK had strong quarters at 7.1 and 4.1%. Similarly, India also had a very strong growth. From digital continues to accelerate. For the quarter, we have close to 18% of our revenues coming from digital. We are now at a run rate of about 3.2 billion on digital. From people perspective also, we continue to hire strongly, and our net addition of 8,700 odd people in this quarter, and attrition again continues to track down, and we are now comfortably within our range with IT attrition only in the range of about 10%. So overall, given the economic environment and seasonality in this quarter, we have had a fairly decent set of performance, which places us well for our as we look into FY18. A few words about FY18. We spent the first 2 months, me and NGS, visiting customers primarily across North America, but across Europe and APAC as well. And a very common theme that we are hearing from all of them is a very strong focus on digital, continuing investments in that, and a balance of an investment agenda, a strong technology transformation and investment agenda, and a very strong focus on operations and efficiency, which I think plays well into TCS's core strengths. And we continue to stay focused on digital. We are focusing on three themes within digital as we build this out, given its size. The three themes being agile, cloud, and automation. And we are focusing the company more tightly around these themes as we see this playing out into our customer context. Finally, to end it, as I said, we see FY18 as incrementally positive and quite confident about the demand outlook that we see. There are few verticals that have some lingering pressure, primarily coming from retail. Other vertical like high tech, which had a soft full year, we have now seen 3 quarters of fairly strong growth coming into it. So we think high tech should do well. BFSI, we think, should bounce back from its cyclic lows. And that's what sets us up for FY18. With that, I want to hand it back to Pradipta, and we'll take it from there.
Thank you, Rajesh. We'll move to Q&A. The first question comes from Kritika of CNBC.
Hi, gentlemen. Congratulations for your first quarter in the earnings press conference. My first question to Rajesh. Rajesh, you gave a breakup of the verticals. Could you throw some more light as to by when are you expecting retail to recover? The structural changes in BFSI as well seem to have hit many IT companies. Is there a possibility that the overhang could continue in parts from a contract-to-contract basis? And even the other problem verticals, for instance, Diligenta and Japan, while the degrowth has been arrested, by when can you see a pickup in growth there?
Of the 4 that you spoke about, BFSI, actually, we are quite positive about it. If you think about it, last quarter also, we had said that we are seeing continuing momentum in BFSI. Insurance continues to do well. And in BFS, what we're seeing is there's a lot of pipeline for small projects. So the deal momentum is fairly high, but the project sizes are smaller. And therefore, some amount of that is translating into volatility in terms of the Q-on-Q numbers. But we met with almost all our key customers in that space. And everyone is very clear about the fact that they are positive about the future and they have a very strong investment agenda. So difficult to say as to when it will be, but BFSI is not a structural problem. We see them on that investment path and we see strong participation in that. So it's only a question of how the volumes build up over time rather than whether there is a this thing. Retail is a more difficult one to call because clearly the industry has structural challenges and many retailers are going through. So all of them have a digital investment agenda where we are participating, but the structural challenges on the industry is fairly strong. And there is financial stress building up in the industry, and we'll have to wait and see how that plays out. So very difficult to say as to when it will come through, and it's likely to remain maybe volatile, maybe soft through the year. Diligent and Japan, I think we should see growth into this year. Japan had a degrowth, which we are positive or confident that it should probably have some amount of growth. Diligenta, we are confident will have a strong year. We have a very good pipeline in Diligenta, one of them close to signing and in the final stages of contract negotiation, and a couple of other deals also which are looking good. So Diligenta should do quite well through the year unless something very significant goes wrong. So overall, difficult to quantify, but directionally quite strong.
A question for NGS. NGS, Rajesh mentioned that the coming year should be incrementally positive. From the conversations that you two have had over the last few months, what is the deal pipeline looking like? Because the sense is that there isn't clear visibility, and that's the reason why NASSCOM has refrained from giving guidance. The sense is by second half, visibility will pick up. So where do you stand as far as incremental deal pipeline is concerned this year?
That we have signed certain number of deals over the last 6 months, and they all are ramping up, and they should do really well, which should augur well for our growth in the coming quarters, number one. Second is with respect to the pipeline per se, we see a very strong pipeline of large deals as well as a combination of several small deals, right? Specifically in the areas of agile, automation, as well as cloud adoption, as the customers are advancing their cloud agenda, right? So across verticals, across geographies, we see a momentum. Our pipeline looks stronger than ever.
My question for Ramki. Ramki, typically I ask Rajesh the margin question. So there has been an aspirational target of 26 to 28%. Will you revise that downwards? Because the sense is that pricing pressure, rupee volatility has led to constraint on margins. Is there a need to moderate that guidance? Rajesh can add to that.
At this point of time, I don't think we need to moderate that. We certainly believe the 26 to 28 band is something which we will focus on. We are a tad short in this quarter and the full financial year at 25.7. But the focus is to get to 26 and to work within that band. We have several things which can work towards that.
And last question to Ajoy. Ajoy, the attrition has been lowered significantly, even if you compare on a year-on-year, quarter-on-quarter basis. Is it a seasonal factor? How maintainable is that? And this is the time of the year that you can give us a target for next year, FY18. Can you give us a hiring target? How have the wage hikes been this year?
Okay, too many questions, but let me try and answer those. One is from an attrition point of view, yes, it is. I think we are at a pretty good spot at this point in time. A number of initiatives that we have taken to build and give opportunities to our people to build their career and to grow within the organization along with the growth of the business itself. I think these are paying off. Similarly, what we announced was the whole training and learning and development related activities that we had embarked on to build digital competencies for our people, given the growth that's happening in the digital era. And that has definitely given the momentum as far as people are concerned. They are seeing that yes, there is something that they can do, there is something that they can look forward to, and the other employee engagement initiatives that we carry out. So given all these factors that are going on, definitely the attrition levels are low, and I think there is still room to bring it down further. So I'm quite hopeful of that. So that answers your first question. As far as hiring is concerned, see, all I can say at this point in time is yes, we are continuing to hire. As you saw, we hired about 33,000 net as far as this year is concerned. Directionally, this year what we hired from a gross addition point of view from 90,000 to 78, that has come down. Similarly, directionally going forward, that will come down. But by how much, etc., will be difficult to call at this point in time, because it also depends on the attrition to a certain extent. If we are able to retain more, in that case, our gross hiring will be less. At the same time, the kind of talent that we are hiring is also going through a certain changes at this point in time. There are engineering graduates, there are management, there are chartered accountants, and also with design kind of skills in India, in overseas. The whole mix is changing, and we are keeping that in checks and balances. So we will continue to hire in all geographies. So that's the basic message. But directionally, the number of gross hire will definitely come down. As far as wage hikes are concerned, this is the time that we announce, yes. And we have given a hike. It's not that there is no hike. And the hikes, again, see, earlier I used to give an average number across the company, right? Overall. So that again is becoming, we are changing that, because that's again becomes very difficult given the kind of different units that we have, given the kind of growth plans that each business unit is coming up with, performance of individuals and all that. And given the pyramid, the averages are different at different levels of the pyramid. So all I can say is it's been from mid to high single digit kind of increment that people are going to see on an average at different bands. And the letters are released, will be released from tonight onwards. So people will start getting the letters from tonight.
And this is both onshore and
on-site, the hike will be different. On-site, it will be from 2 to 5% kind of an average range. Again, that's again going back to the same commentary of different units vis-a-vis different geographies, as well as the pay bands, different pay bands. But on an average, it will be of that order.
Thank you, Kritika. Darshan, ET now.
Thank you for having us here. Firstly, you seem to be giving. You seem to be giving quite. You said that you maintained your guidance. You say that you see growth coming in, but the concern here is that your BFSI, which is your biggest vertical, is growing slower than your overall revenues, and your margin is still coming much lower than what you had guided for the medium term, and yet you're still maintaining a 26 to 28% margin. Infosys also was very cautious as far as their margin is concerned. So is this concern valid that BFSI is not growing, and yet despite this you're giving an optimistic guidance?
I would worry more if the smaller segments were growing lesser than the larger segment. So the fact that the small segments are recording 15-16% growth and BFSI is steadily coming down as a percentage. In fact, it breached the 40% mark. Now it is 39% of revenue. Is structurally a good thing for us. And directionally, we wouldn't expect anything different. So BFSI will continue to typically be close to the average or just above or just below the average, with the smaller ones kicking in with the differential growth. So that's not an area of concern, that is to be expected. And from a margin perspective, we did 26.1% in this quarter, and we have always maintained that the margin is subject to unforeseen volatility on the currency. We give you transparency on that currency side. We were quite frankly caught by surprise at the extent of the volatility in this quarter. And that has flown through onto the margin line, and it will take time for it to get worked through the system. So overall, I think our commentary is based on the numbers that we have put out. And we continue to see decent momentum across many of the verticals that we have invested in service lines like digital, where we have invested in. And the positive commentary is coming from those areas.
Okay, my second question, and it's open to all, anyone can take it. Your constant currency growth was 8.3% now. Now Infosys has guided that next year they'll do probably 6.5 to 8.5. So if they do manage to come out with a number which is 8.5, pretty much the gap between you and Infosys will actually come down significantly. Is that a cause of concern? Will you be able to maintain your lead there?
Numbers. And end of the year, we'll see where we end up with.
We
We'll see.
What about the order by Trump that will come in today? Any expectation will come in today? Any expectations from there? What kind of, can you quantify if there is any negative impact that would come in? And would that possibly mean that some bit of wage hikes could probably be delayed, or can you quantify more on wage hikes also?
So let's wait and see. I mean, we have also seen the reports that an order is coming. So we'll see what the extent of the order is. I want to emphasize that we have always been compliant and we'll continue to be compliant with whatever be the regime, the jurisdictional regimes that we operate in. And per se, is that positive or negative, we will see as it comes.
And my last question, volume growth has come in similar to, volume growth has come in similar to, the revenue growth this time around. Does that mean that, pricing pressure has pretty much peaked out now?
Question. We have always maintained that we are seeing fairly stable realization. Now, if you go back over the last 5 years, actually 5 or even 6 years, we have seen realization being in a very tight band. So for this year, we are talking about 30 bips decline. Last year, we actually had a net improvement. Year before that, it was flat. And in fact, for the last 5 years, it has been like that. So we have always maintained this commentary that we are seeing in aggregate, at the portfolio level, realization being quite stable. And specific service lines will get balanced out per se as we go along. So we don't see a structural breakdown in pricing. Different service lines will behave differently, but that's the nature of this industry, that new services come in at better price points. Older services will keep on declining in their service price points.
Thank you.
Amay, Bloomberg. Yeah, go.
Hi. Yeah, just wanted to ask you, taking a leaf from him, how does TCS plan to adhere to the changing visa norms in US in terms of everything like local hiring? What are your plans? I'm not asking you for the numbers, but how do you plan to, or switching to other geographies, something on those lines? One is that. Second is I want to know the digital mix as of now. Where do you see it like 2 or 3 years down the line as a total mix of revenue? And the third question and last one is you mentioned about the operating margin. Wanted to know what levers will you use to maintain that guidance 26 to 28%.
Okay, so let me take the visa question first, and maybe then I can pass it on. See, as far as visas are concerned, we have been compliant, and we would be compliant going as far as our operations are concerned. And US remains our largest market, so we'll definitely continue to stay in US and continue to meet our customer requirements. And for doing that, whatever business model changes that we will have to do, we will do that. As far as what are the wages and these things are still a matter of conjecture, none of that has been finalized, so we'll have to wait and see. And we'll definitely tweak our model in order to ensure that we remain compliant and at the same time we meet our customer demands. As far as our local hiring is concerned, we have been hiring locally in all geographies. So we have been doing that from the very beginning. And of the last few years, our hiring on-site has been higher. At the same time, we have also said that we are going towards more and more less visa-dependent kind of a business model. So that will be the focus going forward. So I think that is where we are. And any further details will have to wait for more and more announcements to come in. Then we can tweak our model accordingly. Okay? So,
on the margin front, some of the levers which we can talk about, obviously one is as customers look for more and more offerings in the digital technologies, and we are gearing up, and already the growth you are seeing, there is definitely opportunity for increasing the value for these services. So that will happen. Second is in the traditional services, there will be definitely opportunities for increasing the automation and sort of decreasing the linearity there. So there are opportunities there. Plus, we have been very disciplined on our overall operational metrics and factors. So we'll continue to drive that, and we will try and get more out of some of the large spends which we do in various aspects across the organization. So we believe there are these things which are available for working towards our stated goal.
Wage conventionally is taken as a main lever. Is that the case with you? And how much of that can you use? That's what I wanted to
No,
ask.
that will be one of the factors which will be there. As we also, Ajoy talked about the pyramid and things like that. So we will still continue to work on those aspects. But wage will not be the only factor which will be contributing to this.
Yes. How big will digital be?
Digital, customers are clearly advancing their agenda on digital, no doubt about it. And what all is digital will get redefined in the course of time. As you, if you're asking what will happen, what all digital in the 3 years' time or 5 years' time, it will get redefined. But as we see it, there is a tremendous amount of adoption to cloud, tremendous amount of adoption on analytics, and increasingly customers are seeking to go everything agile, and even contracts are getting structured agile. In the way that looks smaller projects, keep looking at contracts in an agile manner, right? So from that perspective, we believe that we have ended this year with a 18.6% this quarter, and we have a run rate of about $3.2 billion. We do believe that our intention is to grow full on digital and maximize our opportunities on digital. And we have trained a lot of our employees on digital. More than 1 million certifications have been accomplished. More than 500,000 competencies in digital have been achieved by our associates. Right, so we believe that we are very well positioned to capture the imagination and opportunities in digital world, right? And customers are also looking for more and more integrated services, which essentially means that you don't not only look at the front end, digital and experience, but also all the refactoring that need to happen in the back end, which will kind of redefine the kind of work that we will have to do in the area. So overall, I see that the digital will significantly contribute to our share of business, let's say 3 years down the line or 5 years down the line.
Thank you. Sankalp from Reuters.
Hi. I just wanted to ask, last quarterly results, Chandra said that you all had decreased the number of visa applications anyway. I was wondering if you could give me a number this financial year, how many H1Bs you plan to apply for. And one aspect that all IT companies say that they want to do is acquire more companies overseas with a tighter visa regime coming in. Are you all going to be looking at acquisitions more, since Indian IT companies have never been too big on acquisitions? And one question is, your growth in Latin America and India has been good this quarter. So what are you all going to do to boost it further?
So you had, in terms of visa per se, our visa usage application and all will be similar this year as compared to last year. We don't give out specific numbers, but directionally it is the same. Approximately we will be tracking to the same numbers that we had last year. As far as acquisitions go, we are very focused that we have a fairly strong track record of acquisitions and integration and growth from acquisition. So one of the most successful acquisition histories in the industry. And the reason it has been successful is that we are careful that acquisitions are made for capability or market access, not for revenue or for people addition. So we'll stay true to that acquisition philosophy, and I don't see that changing based on one regulatory change. Your last question was?
Both in Latin America and India.
Both these markets are key markets. We are very heavily invested in it. We've been very strong in India for a long period of time. And similarly in Latin America, we have almost a 15-year investment history. So these are volatile markets as they circle through from being products to being more service oriented. And the focus is to convert them into annuity markets rather than into project-based markets. So as that is successful, the volatility will reduce and steady growth will come in. As of now, Latin America is still a lot of project-led one. India is slowly converting into a more annuity-based market. And we continue to stay focused on it. We participate in very large transformation engagements, very strong clientele. And we are essentially very deeply invested and leading the markets.
I just had one follow-up question. Now, if a stricter visa regime does come up in the US, Are your clients saying that they will absorb some of the higher costs of business? I mean,
once again, Sankalp, it's too speculative at this point in time. So anything that changes the supply side will have impact across the chain. So let's wait and see what the regulations are. Let me put it this way, we are competitive, and as long as the regimes are broadly equal for everyone, we don't see our relative competitiveness actually going down, as long as it is fair and equal.
Okay, Priyanka from BTV.
I just wanted to ask you like a follow-up on the same, but has there been a decrease in the number of visas that you have applied for compared to the previous quarter? And if there has been, if you could help us with, if you could just give us a percentage decrease or at least quantify the numbers?
See, as far as, I think we have already announced that last quarter or earlier than that, when Chandra had mentioned, the number of visas that we applied last year was 1/3 of what we had applied earlier. And so that we are preparing ourselves, when I said that less visa dependent kind of a business model, so that is in preparation to that. This year, I think Rajesh mentioned that whatever we have applied for, it is very similar to what we did last year. So let's forget about that specific kind of number, but directionally I have given you where we are. And going forward, I think all our attempt is, all our focus is to ensure that we continue to meet our customers' requirement, we continue to deliver, and continue to focus so that we are compliant to all regulations, whatever the regulatory aspects that come up with.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.